Yes, indeed. Let's talk about the debt markets now. In the studio with me in Cape Town is Megan McDonald, Head of Debt Primary Markets at Standard Bank. Megan, thanks very much for joining us. It's been an extraordinary time for capital markets worldwide ever since the crisis first started, and liquidity became a way of life for investors and for central banks. Capital markets have been on fire, and South Africans in particular. Just give us an idea. Let's step back a couple of years and tell us what has happened to the capital market.
Absolutely. Thank you, Lindsay. As you say, it's been a phenomenal growth story for the debt capital market. So we saw the boom leading up to 2007, low interest rates, large amounts of liquidity in the global economy, and then the events of 2008 and 2009. South Africa was fairly well insulated from those events. The local debt capital markets continued to function relatively well, where we saw liquidity all but seize up in international debt capital markets. And the recovery has really continued from 2010 onwards, and we're going to see in the debt capital market here in South Africa this year issuance of over 100 billion rand, which is a phenomenal result given some of the challenges that we see being faced elsewhere around the globe.
Quite right, and you're at the forefront of that, because I've got a report in front of me that says now Standard Bank's debt primary markets team has helped local clients issue bonds and securitisations worth over 40 billion this year. Can you characterise that 40 billion? Can you give us a sort of breakdown of what that 40 billion has consisted of?
Absolutely. So the real star performer of the debt capital markets this year has been corporates. So if you take a step back 10 years ago, the market was really dominated by financials and your state-owned enterprises like your Transnet, Seckam, those types of entities. We had very little corporate bond issuance. That trend kind of continued up until about 3 years ago, when you started to see corporates accessing the debt capital markets. Those were still your blue chip corporates, the household names, the Anglo-Americans, those types of companies. The increasing and the trend that we've seen this year is the widening of the debt capital markets to include many corporate issuers. So of that 100 billion figure that I quoted recently, 26 billion of that year to date, and we expect more to come, has been corporate issuance. That's 100% growth on the 13 billion that corporates issued in 2011. Because
it's more efficient than, for example, a rights issue going into the equity market, because of the easy monetary policy, because of the scramble for yield from investors, maybe all three of them.
I think all three of them, but I'd like to touch on the last one that you mentioned, the scramble for yield. We've seen that as a very important factor driving investor appetite, and not only investor appetite from local asset managers, pension funds. We've seen a phenomenal interest from offshore investors into the local debt capital markets, not only in South Africa, but in the rest of the African continent as well. And that's really driven by the search for yield. They have near zero interest rates in most of the developed world at the moment, so are increasingly turning their focus and attention to Africa.
Of course, at some stage, the easy monetary policy will turn and interest rates will start to rise, and everyone will say, goodness me, this hasn't been the case for 4 or 5 years now, because I think the United States has committed to zero interest rates until 2015. But while we need to make hay while the sun shines, of course. South Africa's had a great year. I mean, apart from being involved in the Wigby, which has boosted money coming into our capital market, there's also been a couple of negatives as well. Credit ratings, for example. How important are they?
Absolutely, and we watch the credit rating story quite carefully. The concern that we have is that we're on the cusp of investment grade, and that's quite a watershed mark for investors in the international capital market. So long as we stay in the investment grade range, we think our local capital markets and the interest from offshore investors will be largely unaffected. We've seen some spread widening due to the labour unrest and some of the challenges that we all know South Africa has faced recently. So long as we stay in that investment grade range, as I said, we don't expect a huge outflow of funds. However, if we do drop below that, it will have a significant impact, we believe, on the ability of our sovereign and various other corporates to tap international capital markets for debt funding.
These funds are capricious, of course. We talk enthusiastically about foreign inflows, and I see statistics coming in every single day about how much has gone in, how much has come out. But of course, this year it's mainly been in for the bond market. They can turn, though, can't they? This money can go out quite quickly.
As the Americans say, they turn on a dime. It's incredibly capricious, as you say. So all you need is one shock in the international markets, for example, and we saw that in 2008 and 2009. Despite the fact that our economy is fairly well insulated from a debt capital markets perspective, that negative sentiment does get here, and we do see an impact if there are those external shocks. The one mitigating factor of all of that is that there's a lot of local investor money in our local corporate bond issues. So the bulk of the money comes from South Africa. So it's not to say that we won't be affected, but the effect is somewhat mitigated by the local money being invested here in South Africa.
Okay, and of course the rand factor as well is one. Rand currently 8.98 against the US dollar. Last 30 seconds, Megan, where's the bond market going in 2013, do you think, the local bond market?
We expect record issuance again, Lindsay, driven by one key factor that we see, which is Basel III. All banks in South Africa have to implement Basel III from January next year.
And they'll use bonds in order to bolster their balance sheets and get the Basel III requirements in place.
Absolutely, and bank lending will become more expensive as a result of Basel III driving corporates into the debt capital markets.